There's a lie sold to almost every beginner who wants to start investing. A lie so well marketed that it shapes the entire industry built around it. The lie goes something like this: investing is complicated. You need to understand market cycles. You need to read financial news every day. You need to pick the right stocks. You need to time the market. You need a financial advisor. You need a premium account. You need to learn options, futures, day trading, crypto, real estate syndications. You need to be sophisticated. Almost none of that is true for a beginner, and the people telling you it's true have a financial interest in keeping you confused. The financial industry makes money when you trade frequently, when you pay management fees, when you buy products with hidden costs, when you panic sell, when you chase trends, when you believe you need their expertise to navigate the market. The financial industry does not make money when you do the simple thing that actually works. They actively need you not to do it, so they bury the simple truth under a mountain of complexity. They market courses, newsletters, premium services, exotic products, and constant noise, all designed to make you feel like investing is something only the initiated can understand. It isn't. The version of investing that builds wealth for almost everyone is so boring, so mechanical, and so unglamorous that nobody can sell it as exciting content. Tonight, I'm going to walk you through what beginner investing actually looks like in 2026, not the version the industry sells. The version that quietly turns ordinary income into real wealth. By the end of this, you'll understand something the industry doesn't want you to figure out. The investing industry doesn't want you to invest simply. They want you to invest expensively. The beginner who refuses to be confused beats almost everyone. So let's stop being confused. Before we go anywhere, let me clear up the biggest misconception that traps most beginners: what investing actually is. Most beginners think investing is about picking the right stocks, finding the next big winner, timing the market, catching the wave before everyone else does. That's not investing. That's gambling with extra steps. Real investing is something completely different. Real investing is the process of owning small pieces of productive businesses, holding them for long periods of time, and letting the growth of those businesses compound your wealth over decades. Notice what isn't in that definition. There's no timing. There's no picking. There's no excitement. There's no checking your account every day to see what happened. Real investing is closer to gardening than trading. You plant, you water, you wait. You don't dig up the seeds every week to see if they're growing. The version most people are sold, the day trading, the stock picking, the crypto speculation, the chasing of hot tips, is something the industry wants you to do because it generates fees, content, and engagement. It rarely generates wealth. Studies have shown this for decades. The vast majority of active investors, including professional fund managers, underperform a simple index fund that just buys the whole market and holds it. Most of them, over long time periods, lose to the boring strategy. If professionals can't beat the boring strategy, beginners certainly can't. The first thing to understand about investing is that the boring version is the winning version, and once you accept that, everything else gets easier. You stop trying to be smart. You stop trying to predict the future. You stop trying to find the next big thing. You just start owning a slice of the economy and letting time do the work. That's investing. Everything else is theater. Before you invest a single dollar, 3 things need to happen. The industry will never tell you this because it slows you down, and slow customers are less profitable. But it's the truth. First, you need to have your emergency fund in place. We talked about this in the $10,000 video. Investing while broke is one of the worst financial decisions you can make, because the moment a real emergency hits, and it will, you'll have to pull money out of your investments at the worst possible time, often at a loss, often with tax penalties, often during a market downturn when prices are low. A real emergency fund, at least 3 months of expenses, ideally 6, sits in a high-yield savings account, not in the market. That money isn't there to grow. It's there to keep you from being forced to sell your investments when life goes sideways. Second, you need to deal with high-interest debt. If you're carrying credit card balances at 20% interest, investing in the market at an expected 7 or 8% return is mathematically backwards. You're guaranteed to lose money on the spread. Pay off the high-interest debt first. The return on paying off a 20% credit card is a guaranteed 20%. No investment can reliably beat that. Third, you need to understand the timeline. Investing is a long game. The market goes up and down constantly in the short term. It only reliably goes up over long periods, usually a decade or more. If you might need the money in the next 3 or 4 years, that money shouldn't be in the stock market. It should be in something stable and accessible. These 3 steps are unglamorous. They don't generate excitement. They don't make you feel like a sophisticated investor. The industry won't promote them because they don't sell anything. But they're the foundation. Skip them and you're not investing. You're building a house on sand. Get these 3 things right and the rest of the journey becomes much, much easier. The industry has invented hundreds of account types, fund types, and investment vehicles. Most of them you'll never need. The vast majority of beginner investing success comes from understanding just a few, the only account types beginners need to know. In the United States, you mainly need to understand 3 account types when you're starting out. The 401k, if your employer offers one. This is the most important account type for most working people because employers often match a portion of your contributions. That match is the closest thing to free money in personal finance. If you don't capture the full match, you're leaving thousands of dollars on the table every year. The Roth IRA, a personal retirement account where you contribute money you've already paid taxes on, and then everything grows tax-free for the rest of your life. For most beginners, especially younger ones, this is the single most powerful long-term investing tool available. There are income limits and contribution limits, but for most people starting out, it's the right move. A regular taxable brokerage account for any investing you want to do beyond your retirement accounts. This is what you use for general long-term investing and what you'll eventually use most as your wealth grows. In the UK, the equivalents are different, but the logic is the same. The workplace pension with employer matching. The stocks and shares ISA, which lets your investments grow tax-free up to a yearly allowance, and a general investment account for anything beyond that. Other countries have their own versions, but the principle is universal. There's almost always a tax-advantage retirement account, a tax-advantage personal account, and a general investment account. Use them in that order. Skip the cryptocurrency accounts. Skip the leverage trading accounts. Skip the options accounts. Skip the alternative investment platforms. Skip everything that promises high returns with low effort. Those accounts exist to extract fees from beginners who don't know any better. The boring accounts are the wealthy ones, always have been. Now we get to the part that most beginners agonize over, the part they think requires the most knowledge, the part that actually requires the least, what to actually invest in. For the overwhelming majority of beginners, the answer is one of 2 things: index funds, or a robo-advisor that invests in index funds for you. An index fund is a single fund that owns a tiny piece of every major company in a market. When you buy 1 share of an S&P 500 index fund, you own a small slice of every one of the 500 largest companies in the United States. When you buy a total market index fund, you own a slice of nearly every publicly traded company in the country. You don't have to pick winners. You don't have to time anything. You don't have to follow the news. You just own the market. And over long periods of time, the market goes up. Not every year, not in a straight line, but over decades, reliably, consistently, the market produces wealth for the people who own it. The numbers on this are clear. The U.S. stock market has produced an average annual return of around 10% over the last century, about 7% after inflation. That's after wars, recessions, pandemics, crashes, and every disaster you can imagine. A beginner who buys a simple total market index fund and holds it for 30 years almost always ends up wealthy. Not always rich, but almost always wealthy compared to where they started. A robo-advisor does the same thing automatically. You answer a few questions about your goals and risk tolerance. The Robo-Advisor builds a portfolio of low-cost index funds for you, automatically rebalances it, and handles the boring stuff in the background. Companies like Fidelity Go, Wealthfront, Betterment, and Vanguard Digital Advisor offer this service for very low fees, sometimes zero fees for small balances. That's it. That's the entire beginner investing strategy. Index funds or a robo-advisor that uses them. The industry doesn't want you to know this is the answer because the answer is too simple to sell. There's no premium service to upsell, no advanced course to take, no newsletter to subscribe to. Just own a piece of the economy and wait. Let me show you something, not a theory, a scene. The two investors, two people opened their first investment accounts on the same Monday in their 20s, same income, same goals, same starting amount. The first investor, let's call him Tom, listens to the financial news every day. He reads articles about hot stocks. He subscribes to a trading newsletter. He follows 3 or 4 influencers who promise to help him beat the market. He picks individual stocks he believes will outperform. He moves money around when something exciting happens. He sells when the market drops because he's scared. He buys back in when it rises because he's afraid of missing out. He pays trading fees, advisory fees, and occasionally pays for premium services he hopes will give him an edge. For 30 years, Tom is busy, constantly busy. He thinks about his portfolio every day. He stresses about the market. He tweaks, he adjusts, he buys, he sells. He believes the activity is making him a better investor. The second investor, let's call her Maya, does something different. She opens an account at Fidelity. She picks one total market index fund. She sets up an automatic monthly transfer that buys more of that single fund every month. And then she does something almost nobody does. She stops looking. She checks her account maybe once a year. She doesn't follow financial news. She doesn't read about hot stocks. She doesn't tweak. She doesn't time. She just contributes every month, automatically, for 30 years. When the market crashes, she doesn't sell. When the market booms, she doesn't celebrate. She just keeps contributing. 30 years later, both of them are 60. Tom has spent decades stressing about money, making thousands of decisions, paying countless fees, and probably losing sleep over the market. His portfolio, after all that activity, is worth less than it would have been if he'd just bought the index and ignored it. Maya barely thought about her money. She lived her life. She raised her kids. She took her vacations. She built her career. And in the background, the boring index fund she bought once and ignored for 3 decades quietly compounded into something most people would call wealth. Same starting point, same amount invested, same 30 years, completely different outcomes. The activity didn't help Tom. The activity hurt him. Every decision was a chance to be wrong. Every fee was a small wound. Every tweak was a chance to disrupt the compounding. Maya won by refusing to play the game the industry was selling. That's investing. The version that works isn't the one that looks impressive. It's the one that requires almost nothing from you after you set it up. The next question every beginner asks is the wrong one. They want to know how much they should invest. The right question isn't a specific dollar amount. The right question is what percentage of your income you should set aside automatically for the rest of your working life. A reasonable starting target is 15% of your gross income going into investments. That includes any employer match from your 401k. For many people, this feels impossible at first. It isn't. It just requires building the habit and then growing into it over time. If 15% is too much to start with 5, or 2, or 1. The amount matters far less than the habit. Once you have the habit of investing every single month, regardless of what's happening in the world or in your life, you can grow the percentage as your income grows. Most people approach investing wrong. They wait until they have enough money to invest. They wait until the market feels right. They wait until they understand more. They wait. And waiting is the most expensive thing a beginner investor can do. The math of compounding is brutal in both directions. Every year you wait to start, the mountain gets steeper. A person who invests modestly starting at 25 almost always ends up with more than a person who invests aggressively starting at 40. The early starter wasn't smarter. They just had time on their side, and time is the single most important variable in investing. Start with something, anything, even $50 a month, even 20. The amount doesn't matter as much as starting, and then increase it. Every time you get a raise, increase your automatic contribution before lifestyle inflation eats the raise. Every time a bill drops off, a car payment, a loan, a subscription, redirect that money to your investments. Every time you get a windfall, send some of it straight to the investment account before your brain has time to spend it. The dollar amount you invest today matters, but the system you build for investing more over time matters even more. The industry doesn't want you to think about fees because fees are how it makes its money, and the more invisible they are, the better, the fees that quietly destroy you. Almost every investment product has fees attached to it. Some are obvious, most are hidden, and over a lifetime, the difference between low-fee investing and high-fee investing is staggering. The most important fee is called the expense ratio. It's the annual fee a fund charges to manage your money. A low-cost index fund typically has an expense ratio of around 0.03% to 0.10%. A typical actively managed mutual fund, the kind a financial advisor might steer you toward, often charges 1% or more, sometimes 2%. That difference seems small. It isn't. Over 30 years, a 1% higher annual fee can cost you somewhere between 20 and 30% of your final portfolio. Not 20% of your gains, 20% of your entire wealth, just gone, quietly, through fees you barely noticed. A financial advisor who charges a 1% annual management fee on top of fund expenses can easily cost you hundreds of thousands of dollars over a working life, sometimes more. The advisor may or may not be adding value equal to that cost. Most of them, statistically, don't. This is why low-cost index funds are so dominant in the math, not because they're the most exciting, because they leave more of your money compounding for you instead of bleeding off to the industry. The wealthy investor obsesses over fees. They know the long-term impact. They refuse to pay 1% to someone who can't beat the index. They refuse to buy expensive funds when cheap ones exist. They keep their costs as close to zero as possible. The unaware investor pays whatever the industry charges, never reads the fine print, and watches a third of their potential wealth disappear over 30 years without ever knowing where it went. In 2026, the tools to invest for almost free are everywhere. Fidelity has zero-fee index funds. Vanguards are among the cheapest in the world. Robo advisors charge between 0 and 0.25%, a fraction of what advisors charged a generation ago. There's no excuse left to pay high fees. The industry just hopes you don't notice. Most of what's marketed to beginner investors should be ignored entirely. Not approached cautiously, not researched, ignored. What to ignore entirely? Day trading platforms. The vast majority of day traders lose money. Studies have shown this for decades. The few who win make money primarily by being on the other side of trades from people like you. Day trading isn't investing. It's a casino with worse odds. Hot tips from social media. Anyone telling you about a specific stock that's about to explode is either trying to sell you something, pumping their own bag, or speculating in ways that have nothing to do with building wealth. Ignore them all, every single one. Options trading. Complex, leveraged, and statistically guaranteed to wipe out most beginners who try it. Ignore until you have decades of investing experience, and probably even then. Cryptocurrency speculation. Bitcoin and a few others may have a role in a sophisticated portfolio, but the entire space is volatile, manipulation-prone, and full of products designed to extract money from beginners. If you must own crypto, keep it to a tiny percentage of your portfolio and treat it as speculation, not investing. Alternative investments marketed to retail. Real estate syndications, art investment platforms, wine funds, sneaker investing apps, almost all of these are designed to extract fees from beginners chasing returns. The few legitimate ones require capital and sophistication you probably don't have yet. Stock-picking newsletters. Almost all of them, over long time periods, underperform a simple index fund. The few that beat the market in any given year almost never repeat. You're paying for entertainment dressed up as expertise. Premium financial advisors with high fees, useful in some situations, almost never useful for a beginner. The fees they charge will cost you more than they save you. Use a low-cost Robo advisor or learn the basics yourself. Anything that promises high returns with low risk. This combination doesn't exist in legitimate investing. Anyone selling it to you is either confused or lying. This is a long list of things to ignore. That's the point. Most of beginner investing success is about what you don't do. The simpler you keep it, the better you'll do. Almost every beginner who fails at investing fails for the same handful of reasons. Knowing them in advance can save you decades of regret. The mistakes that wipe out beginners. The first mistake is panic selling. The market drops. The beginner gets scared. They sell to protect what's left. They lock in their losses at the worst possible moment. And then, almost always, the market recovers, but they're no longer in it. They miss the recovery. They've turned a temporary paper loss into a permanent real loss. The fix is simple. Don't sell when the market drops. Buy more if you can. The market always recovers eventually. Always. The investors who win are the ones who stay in their seats through the storm. The second mistake is chasing performance. The beginner sees a stock or a fund that did well last year. They buy it because they want that performance. By the time they've bought, the run is usually over. They've bought at the top. The next year, it underperforms and they sell at a loss, having missed the actual gains. The fix is to ignore performance entirely. The future doesn't reward what worked yesterday. Stick with the boring index fund. The third mistake is overcomplicating. The beginner starts with a simple plan, then keeps adding to it. A sector fund here, a growth stock there, a tactical allocation to commodities, a small crypto position. Before long, the portfolio is a mess of overlapping positions and competing strategies. None of it works as well as the original simple plan. The fix is to resist the urge to add complexity. Simple beats complicated almost always. The fourth mistake is timing. The beginner waits for the right moment to invest. They want to wait until the market dips, or until things calm down, or until they have more clarity. The right moment never comes, and while they wait, the market goes up, and they miss years of compounding. The fix is to invest the same amount every month, automatically, regardless of what's happening. This is called dollar cost averaging. It removes timing from the equation entirely. The fifth mistake is looking too often. The beginner checks their account every day, sometimes multiple times a day. Every dip feels like a disaster. Every gain feels like genius. The emotional roller coaster leads to bad decisions. The fix is to look as little as possible. Once a year is plenty, once a quarter at most. The less you look, the better you'll do. 5 mistakes, each one preventable, each one fatal if you don't see it coming. The beginner who avoids all 5 is already ahead of the majority of investors, including many professionals. So let me leave you with this. The question you carry with you. Investing for beginners isn't complicated. It looks complicated only because an entire industry depends on you believing it is. The actual blueprint fits on a single page. Build an emergency fund first. Pay off high-interest debt. Open the right accounts. Your workplace retirement plan, a tax-advantaged personal account, and a regular brokerage account if you have more to invest. Buy 1 or 2 low-cost index funds or use a low-cost robo-advisor. Contribute the same amount every single month, automatically, for the rest of your working life. Ignore the noise. Avoid the high-fee products. Stay in your seat when the market drops, and let time do what time always does. That's it, the entire strategy. No newsletters, no premium services, no hot stock tips, no timing, no genius required. The investors who win at this game are not the smartest. They're not the most informed. They're not the ones who watch the market most carefully. They're the ones who refuse to be confused, who stuck with the boring strategy long enough for the math to work, who didn't let the industry talk them into expensive complications, who treated investing the way it's actually meant to be treated, as a slow, quiet, almost mechanical process that builds wealth across decades. The financial industry will never put this blueprint on a billboard, because if you actually follow it, they make almost nothing from you. You don't need their premium services. You don't need their newsletters. You don't need their managed accounts. You don't need anything they're selling. You just need to own a piece of the economy. And wait, so let me leave you with the question, the one that matters more than anything I've said tonight. What are you waiting for? Not in theory, not someday, now. Most beginners spend years getting ready to invest. They read another book, they watch another video, they wait for clarity. They wait for the market to feel safe. They wait for life to settle. They wait for their income to grow. And while they wait, the compounding doesn't happen. Every month they spend getting ready is a month their future self will never get back. The blueprint isn't complicated. The boring version really does work. The simple thing really is the right thing. The only question left is whether you'll actually do it, or whether you'll spend another year waiting for permission to start. Most beginners wait for years, sometimes for decades, sometimes forever. But you don't have to be most beginners. You only have to take the first small step. Open the account, set the transfer, buy the fund. The industry's biggest fear isn't that you'll fail at investing. They've already priced that in. Their biggest fear is that you'll succeed at the simple version, the one that costs them their fees, their commissions, and their grip on you. The boring version of investing is the rebellion, quiet, slow, inevitable, and it starts the moment you stop waiting.